Welcome to part 2 of our tutorial on financial ratios. Just as a recap, financial ratios are crucial tools for assessing a company's financial health and performance. They are common standard calculations being done on the financial statement results of any company because they offer valuable insights into various aspects of the business. Before we dive deep into where we left off on part 1, let's have a look at the mind map to see what we'll be covering for today. So this is the mind map that we currently have on this particular section. We're not adding anything for today, but I do want to point out where we are with regards to today's coverage on part 2. We are going to be looking at activity ratios, which is part of the ratio analysis section of the course. So activity ratios are what we're covering for today. There are a lot of activity ratios that we are covering, different kinds of activity ratios. So without further ado, let's get back into the slides. So what I've done with regards to the activity ratios is I've decided to actually split activity ratios into 3 batches. The reason that I did it like this is so that it would be easier for students to understand and group the calculations together based according to the batches, because the concept of the calculation would be very similar in the batches. So if we look at the first batch here, you'll see that it's looking at the turnover calculation, which is accounts receivable turnover, inventory turnover, and accounts payable turnover. These are called the turnover ratios, and the calculation involved in them is somewhat similar. So that's why they're grouped together so that it's easier for students to remember, as well as, when they were thinking about the formula, it's easier to match it as well. Like with our previous examples, we do have documents that we use as sample financial statements so that we're able to show an example calculation. We currently have sample income statement, which looks at this year number. We also have a sample balance sheet, which is the balance sheet that we've been using for the other calculations as well. No changes in that. So let's look at our first calculation, which is accounts receivable turnover. The accounts receivable turnover is a financial metric that measures how efficiently a company manages its receivable. So it's all about AR management. These are the people that owe the company money because you've sold to them and they bought it on credit, and now you're collecting those monies back into the company. The formula involved in the calculation of accounts receivable turnover involves your sales amount over your average accounts receivable. So just as a caveat, I do want to point out something with regards to sales, because this is not just total sales. With the calculation of accounts receivable turnover, it actually is a very specific sales. We are looking at credit sales. It doesn't include any of your cash sales. With our set of example information and numbers, we don't actually have that split of what is credit and what is cash sales, what is credit sales. We will assume for the purposes of the example calculation that this revenue here, everything is bought on credit. You don't have anything that is bought on cash. Everything is credit. So now we're ready to plot out the numbers. As mentioned, you're looking at credit sales plus your average AR. And that is these numbers here. Let's plot them out. So you have 104,591 over 5,315 plus 6,750 divided by 2. So the accounts receivable turnover amount is 17.34. So that means that accounts receivable turns over 17.34 times. The next calculation we'll be looking at is inventory turnover, which is kind of somewhat similar to your accounts receivable turnover, except that it uses a different number here. So inventory turnover is a financial metric that measures how efficient a company manages its inventory by evaluating the number of times it sells and replaces its average inventory during a specific period. So this is managing your stock. A higher inventory ratio typically suggests that there is effective inventory management as the company is selling and restocking its inventory more frequently. If you have a lower number, then that means that there could be some issues with regards to how you manage your stock, and you probably have a lot of slow moving stock. That's why you're not really restocking as much, you're not really selling and replacing them as much. The calculation involved in inventory turnover is cost of goods sold over average inventory. So with our example calculation, we are looking at COGS for 7066 there, and our average inventory, which is these two numbers here. Let's plot those numbers out. We have 47066, 5003 plus 3517 divided by 2. It is 11.05. So that means inventory turns over 11.05 times. Next calculation, we are dealing with accounts payable turnover. Now, accounts payable turnover, similar to inventory turnover and accounts receivable turnover, the focus is just a little different. We are looking at accounts payable itself. It's a financial metric that measures how efficiently the company manages to pay its suppliers by evaluating the number of times it pays off its accounts payable during a specific period. So, a higher accounts payable turnover ratio indicates that the company is managing its payables effectively because you are settling your obligation as fast as you can or as frequently as you can. This is, of course, very important to work out because you want to know how you manage your cash flow, right? So let's have a look. The calculation involved with accounts payable turnover is using your purchases, or sometimes referred to as COGS, over average accounts payable. Now, purchases and COGS, the caveat to this is very similar to your sales, accounts receivable turnover calculation, that the purchases that you are using has to be on credit. Any cash purchases that you do should not be included in this calculation. But for the sake of our calculation today, we will assume that everything we buy is on credit as well. So the numbers that we're going to be using is COGS and average AP, which is these two numbers there. So let's plot out the numbers. We are going to say 47066 over 6154 plus 5916 divided by 2, and you are left with 7.8. So that is the accounts payable turnovers, 7.8 times. So now we've come to the next batch of activity ratios that we're going to cover. The batch is a bit bigger. We have 5 calculations that we're going to be doing. We have days sales outstanding in receivables, sometimes referred to as DSO as a quicker term. We have days sales in inventory, which is DSI. Then we have days purchase in accounts payable, which is DPAP. And then we have operating cycle and cash cycle towards the end of this batch. So our first calculation is DSO, which is days sales outstanding in receivables. The calculation between the turnover ratios and the days calculation is somewhat similar, except that the components are arranged differently. Okay? In the turnover ratios, we are looking at how many times an element turns over. So we're looking at how many times does accounts receivable turn over, how many times does accounts payable turn over. With the days ratio, we are looking at how many days does it take for the company to actually get cash back, or in the case of days purchase, it's how many days it takes for the company to pay the payables back. So just to give a brief description as to what DSO is, it's a financial metric that measures the average number of days it takes for a company to collect payment from its customers after the sale. As mentioned, it is working out how many days instead of how many times. The formula to use when you are working out DSO, you are going to also use average AR, accounts receivable, but this time you're going to multiply it by 365, which is 365 days for a year, because we have to work it out in a year's time kind of thing, and then obviously over sales. Now sales here, again, caveat, this is credit sales. So let's have a look at what it is in our example. We're looking at average AR, which is these two numbers here, and the revenue number, which is 104591. You'll see that the components are actually just structured differently. Let's plot it out now. Average AR, which is 5315 plus 6750 divided by 2 times 365 over 104591. So that is 21 days. So I just want to also again put a caveat out here that when you're working out any days ratio, so if it's days ratio, you have to put it in full numbers, okay? Full whole numbers. You can't have 21.05, which is actually the answer here, 21.05 days, because you don't have 0.05 days. You have either 21 days or 20 days, right? So it's 21 days in this case. So now we have our next one, which is your days sales in inventory, which is DSI. Days sales inventory calculates the average number of days it takes for a company to sell its entire inventory during a specific period. So it is, of course, very important. The lower DSI you have suggests that the company is efficiently managing its inventory. So it's a little bit of a cross on the turnover ratio calculations, because the turnover ratio calculations, the higher it is, the better managed your inventory is. Whereas with the days, the lower your days are, the more efficient you're managing your inventory. Okay, so the calculation involves average inventory times 365 over COGS. So let's look at the numbers that we'll need here. We are actually looking at these two and the COGS amount. So let's plot it out. We have 5003 plus 3517 divided by 2 times 365 over 47066. So the calculation yields 33 days. So that means it takes the company 33 days to sell its entire inventory for a specific period in time. The next calculation we'll be doing is days purchases in accounts payable, DPAP. So again, similar kind of reasoning and similar kind of definition. It's a financial metric measuring the average number of days it takes for a company to pay its suppliers after making that purchase. The higher the days that you have here, meaning the longer it takes you to settle your payables. Now, when we're looking at something like that, it doesn't necessarily mean that it's bad if you have longer days or higher days. The only thing that you have to worry about is that if the number is higher or the days are longer, that may mean that you are delaying your payment quite a bit, and that may mean that the relationship is not too good with the supplier, because the supplier might be aggravated because you're not paying on time. But it all is dependent on the terms that you have with the suppliers, the negotiated terms. Anyway, Let's hit the calculation here. What you will need with the formula for days purchases in accounts payable is the same, average accounts payable times 365 over either purchases, credit purchases, or COGS. So in this case, the numbers that we're looking at, we are looking at COGS here, and we're looking at these two numbers here. So let's plot it out. 6154 plus 5916 divided by 2 times 365. Then you have 47066. So the days that you have here is 46.8, so that means it's 47 days. Rounding it off to the nearest whole number, 47 days. The next two calculations we'll be looking at needs a bit more of a visual look. Okay, so we have operating cycle and cash cycle. So I want to actually explain operating cycle first. This is a financial metric that measures the time it takes for a company to convert its cash into inventory, sell the inventory, and then collect the resulting accounts receivable from it. Okay, so it actually looks at your inventory plus accounts receivable. That's the operating cycle. Whereas with cash cycle, it follows the cash. Okay, so this is a financial metric that represents the time it takes for a company to convert its investment in raw materials into cash receipts, and then from the sale of that product, then subtract the average days that it takes you to actually pay your accounts payable for the raw materials that you bought. So for cash cycle, you are looking at inventory, AR, and you're subtracting AP. That's what it is. You'll probably note that on the slide there's a little bit of a flow at the bottom of the slide, which basically looks at the operations of a business. You have your purchasing of the inventory, and then you have to pay the accounts payable associated with buying that inventory. Then you sell the inventory, and then you collect the receivables from the sale of those inventory. That's basically your operations of the business. So now that we know what each of the cycle involves, whether it's inventory, AR, or AP, we are now able to work it out. We will use the days ratio to work it out. So we have operating cycle, which is inventory plus AR. So that is DSI plus DSO. And then for cash cycle, it's DSI plus DSO minus DPAP. Now, since we already have these numbers, we will just plot it out. We have 33 days for DSI. We have 21 days for DSO. That means it is 54 days for operating cycle. For cash cycle, DSI is 33, DSO is 21, DPAP is 47. So that means it's 7 days. So it takes us 7 days to actually convert everything into cash. That's pretty good. The lower the number, of course, because it is in days, the lower the number, the better it is. So now we've come to the last batch of activity ratios that we're going to cover, and it has 2 additional turnover ratios to cover. But this time, the coverage is actually on total assets or fixed assets. So the first one is total assets turnover, and the next one is fixed assets turnover. Let's have a look. Total asset turnover is a financial metric that measures a company's efficiency in using its total assets to generate sales. As the name would suggest, it's total assets, so it's looking at total assets. The numbers that you're going to use the formula that you're going to use when you're looking at total assets turnover is using sales over average total assets. With our example numbers, we are looking at revenue and we're looking at total assets, which is this 2 at the bottom here. calculating it using those, we have 104,591 over 87693 plus 45999 divided by 2. It is 1.56. So that's a total assets turnover, 1.56. Now let's have a look at the second calculation, which is fixed assets turnover. As the name would suggest, it is related to fixed assets. Okay, similar kind of logic. What you're trying to do here is you're trying to measure the company's efficiency when they're using the fixed assets, such as your property, plant, and equipment, to generate sales. So the calculation is the same. It actually uses sales, but instead of average total fixed assets, it's now average PPE or fixed assets. The number that you're going to be using is revenue and then PPE amounts. Okay, so let's have a look at that. We say 104,591, which is our sales number, and we are looking at 64,778 and 27,559 divided by 2. So the number here, fixed assets turnover, is 2.17. That's the calculation there. And that is it for part 2 of the tutorial on financial ratios. We're going to hop right on to part 3 to cover the last 2 ratio types that we have, plus the limitations on ratio. I'll see you again on part 3.